Thank you for joining us. Let's get into our next conversation now, everyone. According to data released on Monday by the National Bureau of Statistics, Nigeria's headline inflation rate surged for the sixth consecutive time to reach 22.79% in June. And in June 2023, the inflation rate in Africa's largest economy climbed to a record high of 22.79%, marking its highest level in 17 years. This represents an increase from the previous month rate of 22.41%. And while food and non-alcoholic beverages, which went up by 11.81%, led the list of items that contributed to the rising inflation figure. The World Bank had projected that the removal of fuel subsidy will contribute to the country's increasing inflation, and inflation could rise to as high as 23%. So there you have it. Let's get talking now. Nabila Mohammed is a research analyst at Chapel Hindenham Limited. She joins us virtually now. Thank you for joining us, Nabila. We appreciate you for coming on board again.
Good morning. Thank you for having me.
Yes, good morning, and thank you for joining us again. So talk to us about what you think, what were the factors that you believe contributed to the significant increase in Nigeria's inflation rate in June. And if you look at it, really, quite a lot of people have projected that inflation was going to rise. However, some were still optimistic that perhaps the policy directives from the president and some of the initiative taken so far should be able to cushion the significant effect of the subsidy removal on economy. So talk to us about this.
So true to what you said, the inflation report that was printed yesterday for June was more of a pleasant surprise to us, because we were expecting like 23% in terms of headline inflation, and this was, on the back of the twin effect that it would have the removal of fuel subsidy and the FX devaluation would have on the general prices of goods and services. So when we saw 22.79% as the June inflation, we sort of were surprised pleasantly, and it was largely because of the fact that we were expecting much higher numbers compared to what was printed out. And if we even, just speaking to the tweet that was done by the MBS, where they explained that only half of June was captured in the computation of the CPI for June. It means that the latter part of June, which largely has the FX devaluation element in it, was not really captured. So we still feel that we've not really tested the highest in terms of inflation yet. At 22.79, we are still going to see, the impact that it would have when the FX devaluation leg of it is captured in July sprint as well.
Yes, because I did read that report where the MBS also tweeted on its Twitter handle and said that the subsidy removal impact and the unification of the FX were not reflected in these. So that means that once that is reflected, we should have a higher figure. But again, let me ask you a question. How worse do you think these things will get? Because I've asked quite a lot of people this same question, but it looks like most of them are optimistic. So talk to us about, first, you said that you expected that inflation rate should have been more than this. Why are you envisaging that the inflation rate should be more than this? And secondly, how worse do you think things can get in the coming days?
So the reason why I was expecting a much higher print for June was largely because of the impact we all felt the removal of the fuel subsidy, which would have, which led to higher PMS prices, and of course an attendant impact on the cost of transportation and logistics. So that alone just gave us the idea that would likely see a much higher print for June compared to the 22.79% that was printed for the headline inflation. How do I see things going moving in the coming days. Still, with rising inflation, what happens is that the value of your money is eroded. You are not enjoying so much of how much you earn. So we would likely see that consumer spending will drop. Only if minimum wage is applied and our spending capacity is increased, we will start spending on beyond necessities, so we'll start buying things that are not necessary. But for now, I'm sure most consumers will just stick to what is necessary for them to survive. So that is how I see the coming days will look like with the high inflation.
I need to explain more on the ripple effects of the increased inflation rate on Nigeria's overall economic stability, specifically with investor confidence.
Okay, so when the inflation numbers were printed yesterday, we did a little math, and what we realized that on a year-to-date basis, the CPI has increased by 11.97%, compared to the 22.08% that ESI stood at the end of last week's trading activities. So what that largely speaks to is the fact that, the equities market still portends, very good returns for investors. So if you are invested in the equities market, you should since the start of the year, you should have gained over 22% in terms of returns. Unlike, bothering yourself or worrying about the 11.97% that the CPI has increased by year to date. So in terms of investments, the equities market still looks very attractive, and there's still potential upside for some fundamentalists and sound names, just as your previous speaker mentioned. And we just feel that in terms of investments, you can be looking at the equities if you want, something that is returning above inflation on a year-to-date basis.
Well, I mean, looking at other sectors apart from the equities market, are there other sectors that you think that are safe, that may not feel the impact of this inflation as much? Also, talk to us about specific sectors or industry you think that these inflation, the continuous rise in inflation rate will impact.
Okay, so for instance, the manufacturing sector, that sector, most times import certain things that they would need monies for, and with the continuous rise in inflation, which we've already explained time and time again, our inflation is not demand pull or supply push, which implies that the cost of production is on the high side. So the manufacturing sector will definitely feel the brunt, because they will have to be spending more money to, produce whatever goods or offer whatever service that they have to, and this will most likely be transferred to the end users of these goods and services. So the sectors that I feel will feel the brunt of the rising inflation is largely the manufacturing space, and that's because our kind of inflation is from the supply side and not from the demand side. So their cost of producing and cost of manufacturing will definitely touch new highs, and this also just coupled with the fact that they have taxes to also bother about, and they would try to pass the impact to the consumers. And as I said earlier, consumers would largely want to spend more on necessities right now than luxurious goods items.
I like the fact that you said that the cost of this inflation push is as a result of the supply side. I mean, the effect of the supply side and not the demand side. Talk to us about how you think both the fiscal authorities and the monetary authorities will address this, or perhaps should address this supply side.
So it's no longer news that infrastructure is a very key important thing that we have been discussing, and in fact with the removal of fuel subsidy, the current administration have already made it clear that they would want to channel those funds to improving the state of infrastructure.